Drop your kid off at daycare tomorrow morning, and somewhere in the paperwork you signed is a number that should make you wince. $1,500 a month. Sometimes more, for one child. Multiply that by every family walking through the door, and the math looks obvious. The owner of that building is getting rich off you. Here's the twist. That owner is very likely losing money. Not modus profit losing money. Actual, real, keep you up at night losing money. On margins thinner than a corner grocery store. In an industry where the biggest, best-funded player in the country just quietly closed 90 locations. Something doesn't add up. Let's find out what. So who actually gets to own one of these places? Not just anyone with a love of finger paint and a business loan. Opening a daycare means walking straight into one of the most heavily regulated small business categories in America. And the regulation starts before you've enrolled a single kid. First, there's licensing, background checks, fire inspections, a facility walkthrough covering everything from bathroom ratios to kitchen prep surfaces. That part's relatively cheap. A few $1,000s, a few months of paperwork. The real number shows up when you look at space. Almost every state mandates a minimum square footage per child, roughly 35 to 50 square feet of indoor space, and another 75 to 100 square feet outdoors. Per kid, non-negotiable. Want to enroll 40 children? You need somewhere around 2,000 square feet inside, and up to 4,000 square feet of yard. That's before you've bought a single crib, and the price tiers stack up fast. A home-based operation running out of someone's living room might get off the ground for $5,000 to $30,000. A small commercial center, the kind with a real sign out front, runs $60,000 to $180,000 in seed capital. Go bigger, aim for 50-plus kids with the amenities parents expect, and you're looking at $250,000 or more. Build new, from the ground up, and a 10,000 square foot facility can run past $1.5 million. Here's the part that should make any investor pause. None of that money buys you flexibility. A restaurant can add a second dinner seating. A gym can sell more memberships than it has treadmills, betting people won't all show up at once. A daycare can't do either. The square footage you're licensed for is the absolute ceiling on your revenue. Not a starting point, a ceiling. Every square foot is accounted for. Every child capped by law. And there's no clever operational trick that lets you serve more kids than your permit allows. So before a single tuition check clears, the owner has already sunk 6 figures into a building that can never produce more than a fixed government-capped number of paying customers. That's not a barrier to entry. That's a business model with its maximum revenue written into the lease before day one. Which raises the obvious question. If the ceiling is fixed that low, where does the money even come from? So where does the money actually come from if the ceiling's fixed that low? Start with the obvious layer, tuition. But tuition isn't one number, it's a ladder. And where a child sits on that ladder changes everything about whether they're profitable to enroll. Infants sit at the top of the price ladder. Parents pay somewhere between $1,500 and $1,800 a month for infant care, the highest tuition tier in the building. You'd think that makes infant rooms the most profitable rooms in the center. It's almost the opposite. Infants require the tightest staffing ratio in the entire operation. 1 adult for every 4 babies in many states. A preschool room, by contrast, might run 1 adult for every 10 or 12 children, charging $1,100 to $1,360 a month. Less revenue per child, way less labor per child. Read that again. The room charging the most money is often the room making the least. That's layer 1, and it's already more complicated than it looks from the parking lot. Layer 2, the add-ons before school care, after school care, summer camp weeks when the older kids age out of the daycare, but the parents still need somewhere for them to go from 8 to 5. These aren't huge dollars individually, but they smooth out a center's revenue across a calendar year that would otherwise have brutal seasonal gaps. September enrollment surges, summer enrollment dips, the whole rhythm of a school calendar bleeding into a business that technically isn't a school. Layer 3, the fees nobody budgets for until they're paying them. Registration fees, meal programs, supply fees, small dollars per family, but multiplied across a full roster, they matter. They're often the difference between a center that's break-even and one that's slightly quietly profitable in a good month. Layer 4 is where it gets uncomfortable, because it's the layer most owners don't like admitting they depend on: government money. State subsidy programs pay providers directly for lower-income families who qualify. And during the pandemic, an entirely separate river of federal stabilization funding flowed into the industry, money that had nothing to do with tuition and everything to do with keeping the lights on. For a few years, that money did exactly what it was supposed to do. It papered over margins that underneath were never really there. Then it ran out, and when it did, the closures didn't trickle in. They arrived in waves. North Carolina alone saw over 40 centers shut down within months of losing its pandemic-era stopgap funding. And more than 150 programs statewide have closed since. Multiply that story across every state that leaned on the same temporary money, and you start to see the shape of something that isn't really a revenue layer at all. It's a subsidy, dressed up as a business model, and it evaporated the moment the check stopped coming. So tuition that's most expensive where it's least profitable, seasonal add-ons that smooth but don't transform the math, small fees that nibble at the edges, and a subsidy layer that turned out to be load-bearing. Add it all up, and you get an industry-wide number that should stop you cold. Average profit margins under 1%. Some estimates put it barely above that. For context, the healthy small business benchmark most industries aim for sits around 15%. Daycare operators are running at a tenth of that, sometimes less, while charging families more than $13,000 a year per child on average nationwide. Here's the number that makes it click. Staff salaries, the people actually doing the work of keeping small children alive, fed, and learning, eat somewhere between 50 and 80% of a center's total budget, depending on whose numbers you trust. Not 50 to 80% of profit, 50 to 80% of everything that comes in the door. There isn't room left over for much else once payroll clears. So if tuition is this high and margins are this thin, and the biggest expense line is this locked in, where's the actual money in childcare? It's not in the room with the cribs. It's not even really in the building. Look at the companies that are quietly doing well in this industry, and a pattern shows up fast. The profitable part isn't center ownership. It's everything sold around center ownership. Corporate backup care is the clearest example. Instead of owning and staffing a building full-time, a company like Bright Horizons sells employers a service, guaranteed emergency childcare access for their workforce, sold as a corporate benefit, priced like enterprise software, delivered without the same fixed capacity trap that strangles a standalone center. That single division pulled in $725 million in revenue in a recent year at a 37% operating margin. Sit with that gap for a second. Center-based tuition, under 1% margin, sometimes negative. Backup care sold to corporations instead of individual parents, 37%. Same parent company, same underlying expertise in childcare. Wildly different business. That's not a coincidence. And it's not bad management on the center side. It's structural. A corporate backup care contract doesn't require you to build a 2,000 square foot facility with a fixed licensed capacity in a specific zip code and then hope enough parents show up every single day to cover the rent. It's a service sold on a contract, priced to reflect real value delivered, unconstrained by a permit that caps your revenue before you've opened the doors. Which means the actual revenue layers of this industry split into two completely different economic worlds. One world, the daycare center itself, the thing everyone actually pictures when they think owning a daycare, is trapped between a price ceiling parents can afford and a cost floor set by law. The other world, everything adjacent to it, sold to employers instead of families, looks like a completely different, much healthier business. And that split is the first clue to the real question here. Because it's not that childcare is fundamentally unprofitable. It's that the specific version of it everyone assumes is profitable. You, a building, 40 kids, a waiting list, might be the least profitable way to be in the childcare business at all. So why does the math break specifically at the level of the individual center? That's where the real trap lives. Here's the trap, stated as simply as it can be stated. A daycare center is a business that is legally forbidden from ever getting more efficient. Think about what scaling up means in almost any other business. A software company adds a customer, and it costs them almost nothing. The code already exists. A restaurant adds a second dinner seating, and the kitchen that was already running now serves twice as many tables. Even a gym sells more memberships than it has treadmills, betting that everyone won't show up on a Tuesday at 6. Growth in most businesses means your costs grow slower than your revenue. That gap is where the profit lives. Daycare doesn't get that gap. It's structurally not allowed to. Every additional child requires an additional slice of staff time, set by law, not by choice. One adult for every 4 infants, one for every 10 or 12 preschoolers. You can't run a leaner shift during a slow afternoon because the ratio isn't about workload. It's about how many small children one adult can physically watch and keep safe at once. It doesn't bend for a bad quarter. A center with 40 kids doesn't get to operate more efficiently than a center with 20 kids per child served. It just needs twice the staff, running the same math forever. There's no version of this business where headcount grows slower than revenue. They're chained together by regulation, and that chain is the entire trap. Now put that fixed cost next to the other one that never moves, the building. Rent or mortgage on a daycare doesn't care whether you're at 90% enrollment or 40%. The lease is the same number either way. Most centers need something like 60 to 85% occupancy just to break even. And here's the part that makes it dangerous instead of just difficult. An empty seat today isn't inventory you can sell tomorrow. It's not like an unsold sweater that goes on the clearance rack next month. A daycare seat empty on a Tuesday is revenue gone forever. You can't double up Wednesday to make up for it. So you've got a cost base, staff, that's legally locked to enrollment and can't flex down in slow periods without breaking a safety ratio. And a cost base, rent, that's completely fixed regardless of enrollment. 2 of your biggest expenses, and neither one gives you room to breathe when things get tight. That's the setup. Here's how it turns into a collapse. For a few pandemic-era years, a third source of money quietly filled the gap between what parents could actually afford and what it really cost to run a center at those fixed ratios. Federal stabilization funding. It wasn't tuition. It wasn't really profit. It was a subsidy standing in for a functioning margin that the underlying math never actually produced on its own. When that funding ended, state by state, between 2024 and 2025, it didn't create a slow, gentle decline. It pulled the floor out from under centers that had been quietly running at a loss the entire time, just with someone else covering the difference. North Carolina lost over 40 centers within months of its stopgap funding running dry, then lost more than 100 additional programs once a second round of bridge money expired. That's not 40 separate bad decisions by 40 separate owners. That's one structural weak point, exposed all at once the moment the thing propping it up disappeared. And this is exactly why the venture-backed version of this industry breaks so much harder than the mom-and-pop version. A small independent owner running one underwater center loses their savings and closes quietly. But a roll-up, a company that raised tens of millions of dollars on the promise that more locations would mean better margins, has made a bet that this business behaves like a normal scalable company. It doesn't. Add more centers to a model where costs scale in a straight line with revenue. And you haven't built leverage. You've built 150 separate copies of the same razor-thin, subsidy-dependent, fixed-cost trap, all wired to the same lenders, the same debt covenants, the same fragile assumption about occupancy holding steady. Pull one thread in that structure, one bad quarter, one lender losing patience, one funding cliff hitting all 150 locations on the same calendar day, and it doesn't fail one center at a time. It fails all of them at once, which is exactly what happened next. In 2020, a company called Higher Ground Education set out to prove the trap wrong. Higher Ground ran a network of schools under the Guidepost Montessori brand. Montessori-inspired early childhood education, built for parents willing to pay a premium for it. And unlike the typical family-owned center down the street, Higher Ground had venture capital behind it. Real money, real growth targets, real conviction that childcare could scale like a tech company if you just moved fast enough. They didn't stop at daycare centers, either. They expanded into elementary and middle school programs, built their own teacher certification pipeline, acquired a scattering of adjacent education startups along the way, and grew a footprint that eventually passed 150 schools across the country and overseas. At its peak, it was the largest Montessori school operator in the world. Since 2020, the company raised $335 million in funding to make that happen. Here's the number that should stop you. Across 5 years, the company posted over $440 million in cumulative operating losses. Not raised and reinvested, lost. $106 million in 1 year alone, $103 million the next, $55 million more after that. Every single year, spending outpaced revenue, and the gap kept getting patched with the next funding round instead of closing on its own. That's the tech company playbook. More or less, burn cash aggressively, chase scale, assume the unit economics sort themselves out once you're big enough. It's worked for plenty of software companies. It does not work here, and Part 4 already told you why. This isn't a business where growth makes each additional unit cheaper to run. Every one of those 150 schools carried its own fixed lease and its own legally mandated staffing ratio. Scaling didn't create leverage. It just multiplied the same fragile math 150 times over, all tied to the same lenders. In early 2025, the lenders stopped waiting. Higher Ground defaulted on key loans and couldn't refinance or raise new capital to cover the gap. What followed wasn't a gradual retreat, it was a cascade. Landlords foreclosed, lenders seized assets school by school. The network that had taken 5 years and $335 million to build came apart in a matter of months. By the time the company filed for Chapter 11 bankruptcy in June of 2025, it had gone from over 150 schools to 7. 150 schools to 7. Read that again. A separate newly formed organization eventually stepped in to take over most of the surviving Guidepost-branded schools and the majority of enrolled children. Around 8,000 of the 10,000 who'd been attending kept their spot in a classroom without interruption. But the company that built the empire didn't survive it. The bet that childcare could scale like software didn't just fail to pay off. It failed catastrophically, publicly, in bankruptcy court. Now here's the part that should really unsettle you. Higher Ground wasn't a scrappy outsider that didn't understand the industry. And the company that shows the same pressure isn't some fringe operator either. It's Bright Horizons, the largest, most established, most professionally run childcare company in America. Publicly traded, decades of operating history. And between the end of 2022 and early 2026, Bright Horizons quietly closed a net 90 centers, over 8% of its entire physical footprint, specifically targeting its lowest occupancy locations. In early 2026, the company nearly doubled its planned closures for the year, from a range of 25 to 30 centers up to 45 to 50, after impairment and lease termination charges dragged its reported earnings down by a quarter in a single quarter. Two very different companies. One burned through the trap trying to outrun it with venture capital and collapsed in 18 months. The other has spent years carefully, deliberately shrinking its way around it, center by center, one underperforming lease at a time. Different strategies, different timelines, same wall. And if the best funded, most reckless bet in the industry failed this badly, and the most careful, most experienced operator in the industry is still retreating from its own core business, that's not two unrelated stories. That's the same structural trap, confirmed twice, from opposite directions. So does any of this actually work? Is there a version of owning a daycare that comes out ahead? There is, but it's narrower than most people assume going in. The best case looks like this. A center in a dense urban area, or built around a corporate contract, with a wait list instead of empty cribs, sitting comfortably above that 85% occupancy line month after month. Low staff turnover, because turnover is its own hidden tax. Every departure means retraining, temporary understaffing, sometimes a scramble to stay within ratio. A lease locked in early, before rents climbed, run that way for years, without a funding cliff or a bad quarter knocking the occupancy line out from under you, and a center can land in the 10 to 15% margin range. Not extraordinary. but real and durable, and earned the hard way, one enrolled child at a time, with almost no room for error. The worst case is everything you just watched happen twice. A model built on the assumption that more locations means better economics, funded by capital that expects fast returns, betting on occupancy and subsidies holding steady long enough to grow into profitability. When either one wobbles, a funding program expires, a lender loses patience, one region underperforms. The same fixed costs that made every individual center fragile make the whole network fragile at once. Not a slow decline, a cascade. Here's what ties both of those back to where we started. Somewhere between the parent writing an $1,800 check every month and the owner watching that money disappear into payroll and rent, there's a business that looks, from the outside, like it should be printing money, and is instead one of the least forgiving models in American small business. The real lesson isn't that daycare owners are bad at running businesses. It's that the version of childcare everyone pictures, you, a building, a room full of kids, a waiting list out the door, might be the single least profitable way to be in the childcare business there is. The money was never in the daycare. It was always in everything built around it.